Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the confusing mess that is corporate finance and give you the straight dope. In this video, we're diving deep into the Lord Abbett Bond Debenture Fund's latest report, and let me tell you, it's a journey through a whole lot of numbers that mean quite a lot for your investments. Now, this report gives us a snapshot of the fund's holdings as of June 30, 2025. Think of it like a company's resume for its investments. What catches the eye immediately is the sheer scale of this fund. We're talking over $21 billion in assets. That's a huge chunk of change. Before we even see where the money is going, let's talk about what it costs you. For every $10,000 you invest in Class A shares, you're looking at about $40 in costs for the period. Class C shares, on the other hand, will set you back around $71 for the same investment. This little difference in cost percentage, 0.79% for Class A versus 1.41% for Class C, can really add up over time. It's like choosing between a slightly cheaper car that costs more in gas and maintenance over the long run, or a slightly more expensive one that's more efficient. Over years, that difference can be substantial. Let's look at some of the headline numbers. The total net assets are a staggering $21 billion. That's a massive amount of money being managed. The fund holds 866 different investments, which suggests a pretty diversified portfolio. But here's a number that jumps out, a portfolio turnover rate of 156%. What does that mean? It means they're buying and selling investments pretty frequently, almost replacing the entire portfolio within a year. This can sometimes mean a lot of trading costs, but it can also signal that the managers are actively trying to adapt to market changes. Now let's break down where the money is actually invested. The biggest chunk by far is in corporate bonds at almost 67%. That's where the bulk of the fund's eggs are. Then you have government-sponsored enterprises pass-throughs at over 11%, which are essentially securities backed by mortgages from government-sponsored entities. Non-agency commercial mortgage-backed securities make up about 5%. Foreign government obligations and asset-backed securities are also present. It's a mix of different types of debt instruments, which makes sense given it's a bond fund. Now for the really detailed part, the schedule of investments. This is where we see the exact companies and bonds the fund is invested in. Scrolling through this, you see a massive list of corporate bonds from all sorts of industries. For example, there are large holdings in companies like Boeing, Ford Motor Credit, and various banks. Take BAE Systems plc, a major aerospace and defense company. The fund holds a significant amount of their bonds. Then there's the auto sector with Ford and Nissan. They're also heavily invested in the banking sector with bonds from Citigroup, Bank of America, and numerous international banks. Within the banking sector itself, the investments are incredibly diverse. Spanning from ABN AMRO to Zions Bancorp, this diversification across different banks and even different countries like Australia, Spain, and Japan shows a strategy to spread risk. Looking at the food sector, there's a substantial investment in Albertsons companies, the grocery store giant. This shows a bet on consumer staples, which tend to be more resilient during economic downturns. When we look at the non-agency commercial mortgage-backed securities, we see a lot of trust series like ALA Trust Series 2025, ANA, BX Commercial Mortgage Trust, and others. These are complex financial instruments tied to commercial real estate. The fact that they make up a significant portion of the portfolio shows a willingness to take on a bit more risk for potentially higher returns. The sheer volume under corporate bonds is truly remarkable, exceeding $16 billion. This indicates a strong conviction in the corporate debt market. The fund also has significant investments in floating rate loans, totaling over $561 million. These are loans where the interest rate can change over time, often tied to benchmark rates like SOFR. This can be beneficial in a rising interest rate environment as the income from these loans can increase. Then there's the foreign government debt. Investments here include bonds from Argentina, Brazil, Colombia, and even El Salvador, which have varying degrees of risk. The presence of debt from countries like Argentina and El Salvador, which have historically faced economic challenges, highlights the fund's strategy to seek higher yields in emerging markets, but also carries inherent risks. Government-sponsored enterprises pass-throughs total over $2.7 billion. These are generally considered safer parts of the bond market as they are backed by government entities. Interestingly, the fund also invests in an underlying fund, the Lord Abbett Private Credit Fund. to the tune of over $222 million. This is like a fund-of-funds strategy where they invest in another fund managed by the same company to gain exposure to specific asset classes. Now let's look at the statement of assets and liabilities. This is like the fund's balance sheet. Investments are valued at over $24 billion with about $2.8 billion in investment securities sold, meaning they've committed to selling them but haven't yet delivered. This is a common practice and often used to manage cash flow. Total assets are nearly $27.8 billion. On the other side, we have liabilities totaling over $6.2 billion. The difference, $21.5 billion, is the net assets. It's important to note that this total net asset figure is broken down by share class. Class I shares have the largest portion of net assets at over $9.8 billion, followed by Class A at $4.6 billion. This shows where most of the money is concentrated. Moving on to the statement of operations, this shows the income and expenses. For the 6 months ended June 30, 2025, the fund generated over $711 million in investment income. That's a significant amount of money earned from its investments. However, running a fund like this isn't cheap. Expenses, including management fees, 12B1 fees, and administrative costs, come in at over $66 million. Even after some fees were waived, it's still a substantial amount. After all said and done, the net investment income for the period was over $644 million. That's the profit from the fund's holdings before accounting for gains or losses on market movements. Then we have the realized and unrealized gains and losses. The fund experienced a net realized loss of over $262 million on investments, but an unrealized gain of over $422 million. This highlights the volatility of the market. It means some investments were sold at a loss, but the ones still held have gained value on paper. The overall result is a net increase in net assets of over $84 million from operations. This is a positive for the fund, but it's essential to remember that this is just for a 6-month period and market conditions can change rapidly. Finally, the financial highlights show per share data. For Class A shares, the net asset value per share at the end of the period was $7.18. The total return for the period was 3.8%. The total return for the period was 3.80%. It's important to compare these numbers across different share classes to understand the impact of expenses. For instance, Class C shares had a higher expense ratio, which is reflected in their total return. When you look at this report, a few things stand out. The sheer size of the fund, over $21 billion, makes it a significant player in the bond market. They're actively managing this money as shown by the 15.6% portfolio turnover in backed securities and even some riskier foreign government debt. The large allocation to corporate bonds, over 60%, shows a belief in the stability and return potential of the corporate sector. While the fund generated a net increase in assets from operations, the significant realized losses on investments highlight the inherent risks of bond markets, especially in volatile economic times. Remember, even with diversified holdings, market downturns can impact performance considerably. The difference in expense ratios between share classes, particularly Class A and C, is a crucial factor for investors to consider. That seemingly small percentage difference can translate into inherent risks of bond markets, especially in volatile economic times. Remember, even in the world of finance, every dollar saved on fees is a dollar that stays in your pocket. So what's my take on this? Lord Abbett Bond Debenture Fund is a massive, actively managed fund focused heavily on corporate debt. They're taking calculated risks, especially with their foreign government and asset-backed securities holdings, aiming for high current income and capital appreciation. The fund is making money, but the significant realized losses suggest that they're not immune to market downturns. The biggest takeaway for investors should be to pay close attention to the share class costs and the fund's overall strategy. What do you guys think about this fund after our deep dive? Is it the kind of investment you consider, and which share class makes the most sense to you? Let me know your thoughts in the comment section below. And if you found this breakdown helpful, give this video a thumbs up and subscribe to Corporate Decoder for more insights into the financial world. We've also got a Discord community linked in the description where you can connect with other viewers and discuss these topics further. Thanks for watching, and I'll see you in the next video.